Patrick from Peoria. This is a bit more of a process-related question. In the trade trend tail model, will you please discuss how you think about the 3 weeks to 3 month time period between trade and trend durations?
Yeah. So when you
It's sort of the transition.
Yeah. That's a real good one. Before I do that, can you show the way that I actually look at, like, all my models have always been this way, going back to when I first was tasked with running a carve-out of a portfolio. A carve-out means that the guy that was my boss, this guy John Dawson, and Russell Herman, who was above me, who ran the total book, I ran a carve-out of the book. So then I started looking at, I had to make money, right? You either don't lose money and then make money, or you get fired. That's the way it goes. So if you look at that factor exposure table, I'm not talking about factor exposures here, but I'm answering the question in terms of how I look at quite literally anything that ticks. I got anything that ticks is 1 day, 1 week, 1 month, 3 months, 6 months. I really don't go beyond that. The trend, as soon as I know what it is, I just ride it. And then that's why I built the model to look for phase transitions. Again, most people, until they started working with me, didn't even know what a phase transition was. Okay, so again, that's when you move from one quad or economic state to another. But again, if we just use that 1 day, 1 week, 1 month to 3 month, it's really simple to understand. And that's actually why I think I'm better than bad at this, is that I do the same thing the same way every day. But everything changes while I'm doing the same thing the same way. So you get that? So again, when you look at something, and we call this multi-duration, okay? Multi-duration, okay? Multi-dur, all right? So we got the 1 day, we got the 1 week, we got the 1 month, we got the 3 month, okay? So if you look at all three of these durations, they're all separate. So again, they're not the same. Now this one, on a 1 day, if we're looking at something like XLF, you get XLF gets that. On a 1 week, XLF, on 1 month, 3 month. Okay, so that fits. I like that one more. So that's why I wrote the other day that financials have moved to the #1 in terms of signal strength. Okay, signal strength. Signal strength is 4 for 4. Okay, 4 for 4, not quad 4. That's 4 for 4. Now, if I look at something that tech on this one in particular has been. So if we look at let's use XLK. Actually, I don't like XLK. I've already said that because I don't like Apple. Let's use Apple because that's the one I'm actually short. I'm not short the XLK because it's got a lot of Microsoft in it. And as you know, Microsoft in your daily risk range product is bullish trend. But what I noticed the first time that Apple went down is that it goes like that. Then 1 week price momentum went negative. Then 1 month price momentum went negative, which is the leading indicator of this going negative. Because the machine doesn't care that you have an iPhone. It doesn't care what Drawdown has to say about I'm long high quality stocks, right? It cares that this is negative price momentum, and that therefore says that the probability for this is probably bad. Okay, and I'll just stay with that until it's not. And guess what the leading indicator for Apple to not be a short is? Oh, right here, right here. 1 day, Apple will be up. Okay, that's cool. And then on a weekly, week over week, it's going to be up. Why do you think on Mondays I write week over week? Yeah, you're getting down to the studs on this, right? Right? Yeah. 1 month. You know, so then it'll change, and the machine will push it higher. All right. So is that a good? Does that answer the question? Okay, cool.